For this mock exercise, we're going to take a look at a company called Hornberger, and we're going to analyze long-lived assets and analyze the cost and calculate depreciation called straight line. So let's take a look at the question. So this question is a very simplistic one, but it allows us to understand what items we need to include in the cost of the asset. So first, the company bought a machine on March 15, 2009 for $75,000. That's the purchase price. The company also paid $1,000 for delivery. So the question for us is, we need to determine whether the delivery cost should be included in the cost of the asset or should be expensed as an operating expense. And the key thing to remember is if this delivery charge is important or is necessary to get the asset, the machinery, to its intended use or to its location for it to be useful, then we need to include it as part of the cost of the asset. So in other words, the question is it necessary? Is it required to get the asset to its intended use? And the answer is yes, then we should include it in the cost of the asset. So in this case, the delivery charge is definitely it should be added to the cost of the asset. Then it says $200 for insurance while the machine was in transit. Again, the next question is that necessary? Is that included? Can we include it? And the answer is yes, because it's part of getting the asset. So if we didn't buy this equipment, we would have incurred that insurance. That's another way of looking at it too as well. So the answer is yes, we need to include that as part of the cost of the asset. So why don't we start answering the question. So part A is asking us the cost, calculate the cost of the asset. So the cost of the machinery should include the purchase price, $75,000. We know we need to add the delivery of $1,000, insurance in transit, it's $200. Now, what else do they have? It says $1,800 for 1 year insurance policy. And again, the next question is that necessary to buy the equipment, the machinery? The answer is no. And really, this is, in essence, a prepaid insurance, isn't it? Because if they just paid for the 1 year insurance policy, then it is part of running the normal course of business. You would buy the insurance to insure your building and other equipment or other machinery. So to me, this is really not part of the cost of buying that machinery, and it's part of just, part of operating expenses. And in fact, by buying that 1 year insurance policy is really more of a prepaid insurance, isn't it? So the answer is no, it's not included as part of the cost of the asset. And it says $2,800 for testing and installation. And again, we need to test the machine and we need to install the machine to make it useful and safe for our employees and getting the asset or the machinery to its useful condition. So the answer is yes, we need to add that to the cost of the machine. So testing and installation. Okay, we need to add that in there. That's $2,800. Now, so there's no other cost. So to answer part A, what is the cost of the machinery? We need to add all of this, and this gives us $79,000. Okay. Now, part B says, when should the company begin the depreciating the machine? Is it March 15th when we bought it, the purchase date? Is it April 1st? Is when it's ready for use? Or is it May 1st, start using the machinery? So that's the question, right? So the answer to part B is, when is the period, when is the start of the depreciation? It's definitely not the purchase date, because the purchase date is the date in which you bought the machine, and of course you need to obviously deliver it still, you need to install it, you need to test it. So chances are a machine isn't useful, the company can't use the machine at that point in time, so it can't be the purchase date. Then the next logical choice is either when the machine was ready for use, which is April 1st, or when they actually start using it. So I guess we need to go back and understand what is the purpose of depreciation. And the purpose of depreciation is to reflect the use of the asset. And because we're using the asset to help generate revenue, we need to reflect the associated cost of using the asset to help generate revenue. So the answer is, we really should be using the May 1st start date, even though the asset was ready to use, but the company didn't use it. So therefore, the start of the depreciation is really the date in which the company was using the asset. So the answer is, it's May 1st. This is the start of using the machinery. The start date. Okay? And that is when they had consumed the machinery's economic benefit. So this is the date in which the company consumed the machine's economic benefit. Okay? Now there is something else. It says the company has estimated that the machinery has a 10-year useful life with no residual value, and is expected to consume the machinery's economic useful life evenly over the useful life. So the depreciation method of choice should be straight line, because the economic benefit, because remember, it actually says that the economic future benefits evenly over the useful life. And the word evenly should probably give you a little bit of a hint that the more appropriate amortization or depreciation method is the straight line. Okay? So obviously, under our standards, we have the ability to pick different depreciation method, but given the fact that the purpose behind depreciation is to reflect the economic benefit or the use of this asset, and given the fact that we're told that the use of the asset is evenly over the useful life, then the more appropriate choice really is straight line. Now, if you were to ask what is the depreciation amount for the first year of use, well, definitely the depreciation expense, I guess we need to calculate the annual depreciation expense, is the cost of the asset, which is $79,000, minus the residual value, which is 0, divided by the useful life. In this case, we're told it's 10 years, to give us the annual depreciation of $7,900. But the date of when the equipment was used was May 1st, we need to prorate. We need to multiply from the date of use, so May to December is 8 months. So we need to multiply 8 over 12. So therefore, in 2009, total depreciation equals 7,900 times 8 over 12, which is 5,267. That would be the first year. And the key to remember is you got to watch the date. The date, when you're calculating depreciation expense, oftentimes you calculate the annual rate. But given the fact that the depreciation or the asset was not used, was not ready to be used, or wasn't used until May 1st, you need to count how many months of use. It would be May to December, that would be 8 months, and that's why we have to prorate it. So the first year depreciation is 5,267. Thank you.